And take a look at the market's reaction, what it means for your portfolios. Right now, we have futures moving lower on the heels of this hotter than expected inflation print. Housing driving more than half of the gains that we saw last month. So is it too early? It sounds like it for the Fed to declare victory on inflation. We want to bring in Max Kettner. He's HSBC Chief Multi-Asset Strategist. It's great to have you here. So first, your reaction to the print that we got this morning and what you think, if at all, this changes the calculus for the Fed.
Yeah, good morning. I don't think it changes the calculus for the Fed, let's say, upside down, but at the margin, it is definitely a bit more hawkish, right? So when we look at things like the super core inflation that you guys were just talking about, let's remember that also all sorts of, different kind of measures of inflation are also starting to pick up. So you look at, underlying inflation, super core and all that. You look at that on a three-month basis, or you look at it on an annualized 6-month basis. And it's all sort of looking like the last 2-3 months, it's been bottoming out and really starting to pick up again, right? So that's not good news for the Fed. It doesn't change the calculus for the Fed in the sense of like, oh, there's going to be no rate cuts at all this year. But definitely pushing a March rate cut through is going to be incredibly tricky, right? So March and May to me seem very, very, very unlikely with those kind of prints. Because remember, what we've not seen in that report, we see that in other measures. We're seeing, for example, in some of the company surveys that, things like output prices are starting to pick up, that compensation plans, wage plans are starting to pick up, right? So we're starting to see, underlying measures, median CPI measures picking up. We're starting to see, of course, supply chain pressures rising again with the disruptions in the Red Sea, right? We've started to see air freight rates going up at the end of 2023 anyway, before all the Red Sea disruptions. So it's pretty much across the board that it's not like we're seeing a massive second wave of inflation. But I think we're pretty close to actually the low end sort of core inflation. I think people are underestimating that, sort of 2.6, 2.7 handle in core inflation is perhaps the low end. We might be at risk of picking up then again.
Not a massive wave, as you mentioned, Max, but in some key areas where it is continuously sticky. How should an investor who's trying to read through this print here this morning, what is the first trade that they should be considering as they're looking at some of those stickier areas of inflation?
Yeah, it's the dollar. It's long dollar, right? This really calls for a long dollar environment. And this is extremely different from the last 2-3 months ago. Because remember, in the last 2-3 months, think about what happened in the last 2-3 months. We've seen essentially a rally across everything. Imagine if 3 months ago you had said, I am massively bearish. I'm long the Japanese yen. I'm long gold. I'm buying 30-year treasuries. So essentially, you're buying all those sort of typical safe havens, right? What we call typical safe havens. You would have been equally as correct as if you'd been like, I'm actually massively risk on. I'm very optimistic, very bullish. So let me buy high yield and equities and emerging market debt. But both rallied in tandem, right? Everything got swept higher by lower yields. But the point now is when we look at these shorter term inflation expectations, what the swaps market is pricing in. So what shorter term inflation expectations are priced like in the market, they've massively, massively dropped over the last 2 months. Just to give you an indication, in the Eurozone, about 3 months ago on the 1 year part, right? So for the 1 year inflation expectations, we were talking about a 3 handle. Now that's down to 1.5% in the US. We were talking about 2.6, 2.7% for a 1 year inflation expectation that markets were projecting. Now that's already below 2%. So given those really low near-term inflation expectations already, it was at least at risk of partially that broad-based rally unwinding from the last 2-3 months. And in that environment, what works is long dollar.
So, Max, when it comes to the volatility that we could see, or maybe this trading almost sideways here until we get another data point confirming that maybe the Fed could potentially cut rates, I guess, what does this report signal to you about the appetite for risk and some of the moves that we might see play out in the markets here over the coming weeks?
Yeah, I think over the coming weeks, I'm not too optimistic, right? So we were very, very bullish really on equities, on high yield credit, on emerging market debt, really across the risk spectrum for most of last year. But this is the first time since the beginning of last week where we're sort of hitting the pause button a little bit on risk assets. simply because things are starting to look a bit shaky on the inflation side, right? It looks like we've overdone this a little bit too much in the short term. And in terms of the sort of risk appetite that you've asked about, when we look at our aggregate sentiment measures and positioning measures, which is sort of a mix between discretionary and systematic positioning, right? So how fund managers are positioned, how they're viewing the world, how they're positioned in terms of the broader risk on, risk off spectrum, but also systematic investors. So things like risk parity or volatility target funds or CTAs. The crucial thing right now is not only has sentiment and positioning become much more stretched compared to 2.5 months ago, but it's also broad-based, right? It's not just one particular part of the investor community where positioning is a bit more stretched. It's really across the board where sentiment and positioning is a lot more stretched, and that argues for risk appetite to be a little bit lower, I think, over the next couple of weeks, and that we're at risk of seeing at least a little bit of a correction, right? And of that broad-based rally across everything, right? That at least being partially unwound in the next few weeks.
What do you believe the worst thing is that CEOs can signal about the economy right now, even outside of the economic data that we might be seeing come through and still looking for a trend to be locked in for the Fed? What is the thing that you would be watching for this earnings season?
Yeah, look, on the reporting season, the consensus is actually for an almost 8% decline quarter over quarter for earnings, right? So it's very, very pessimistic. Again, at the moment, you're sort of in a lose-lose position, because when you look at things like earnings revisions against global equity performance, then the global equity performance has already baked in a lot of good news. So even if the reporting season does actually surprise to the upside meaningfully, which I think is entirely possible, right? Absolutely possible, given how strong actually, again, Q4 was from a top-down side. But the problem again now is on the inflation side, right? We're now expecting a March rate cut, right? The market is now really starting to say, oh, they're going to have to cut in March. And if not, then it has to be May. So the problem is, even if the reporting season does turn out to be better, and even if CEOs actually do start to say, look, our guidance is improving, things are literally really picking up, right? That actually could be, in some ways, as perverse as it sounds, it could be pretty bad news from a market perspective, because it really does take off some of those Fed rate cuts, and it does call into question that valuation-driven rally that we've seen in Q4.
Max, always a pleasure to get some of your insights here. Thanks for helping us break down what investors should be watching for, especially coming off of this CPI print. Max Kettner, HSBC Chief Multi-Asset Strategist. Great to see you.